Well, thank you, Brian, and I'm glad you're all with us today. And hopefully, everybody is doing okay and starting to emerge from our work from home situation and getting back things to normal. For those of you who want a copy of the presentation, I did get a direct phone call on the presentation a little bit ago. It is in the chat. You can see it at the bottom of the center bottom of your screen there. So if you do need a copy of that presentation, click on the link if you hadn't received it as of before, and it is in PDF form. And so by all means, we have 1.5 CPE today and tons to cover. So let's get this party started. For those of you who are keeping score, my beloved Boston Celtics got blown out last night by the Brooklyn Nets, also known as the dream team of this year. In all seriousness, our session today is about an hour and 15 minutes, maybe a little longer, including questions you may have and various check-ins. Today is hopefully our last shot at the buzzer to keep the basketball analogy going, to implement GASB 84, and for some of us implementing GASB 97 at the same time. Here's my contact information just in case you need it and you'll want to reach out to me directly. I'm more than happy to talk to you about the session as well as Statement 84 and Statement 97 directly. Our agenda today, I've presented at least 11 webinars and written countless words and answered countless more questions on both GASB 84, Fiduciary Activities, and GASB 97, certain component unit criteria and accounting and financial reporting for Internal Revenue Code Section 457 Deferred Compensation Plans since the issuance of GASB 84 back in the dark ages. Do you realize that GASB 84 was issued in January of 2017, over 4 years ago? I can't believe it's been that long. And yet some of us still don't quite understand it. Now, before we all start thinking that GASB 84 was being overturned completely by GASB 97, well, you didn't get your wish. However, some aspects of GASB 84 are clarified by the issuance of GASB 97. And in some cases, things that are or were potentially fiduciary activities may not be reported as fiduciary activities as a result of GASB 97. You know, in the words of former chairman, I hit the button too much. In the words of now former chairman of the GASB, Dave Vowd, GASB 84 is a monster, and he's exactly right. It's not as bad as Statement 68 for those of you who implemented pensions. We all know what happened in implementing GASB 68 or 75 for OPEB. I literally was just on a roundtable over the last 3.5 hours on reviewing what went right and what went wrong with GASB 68 with the GASB. And that was a fun session. And I did mention the words of the former chairman that GASB 84 is a monster, and it did clarify some stuff in GASB 68. The statement, GASB 68 has upended GAAP that it had been in place since prior to the GASB's existence. And the thing we're running into is that GASB 84 does run counter to some entities' policies, procedures, and in some cases laws, especially with respect to student activity funds. For those of you who have not implemented, have implemented GASB 84, in certain cases, some of the decisions may need to be revisited, especially in the case of reporting deferred compensation arrangements and other employee benefit arrangements that you may not have control. And so we're going to get into some of that stuff, as we go along. Indeed, GASB 84 is a sleeping giant. The statement contains some of the most unclear language I've ever read in a GASB statement. The other unclear language had to be with GASB 75, and then a few statements before that with GASB 68. The result of the interpretation of that language may impact processes, procedures, policies that have been in place since prior to the GASB. So this is a very, very big deal. And the implementation is now. I do see a Q&A here, just real quick. Let me see if I can answer it. If the controller decides to postpone the implementation of the GASBs that are postponed by GASB 95 due to COVID, can the external auditors have it as a finding? Another way to put it is, who makes the final determination if postponement due to GASB 95 is appropriate? As far as I know, there's nothing in the audit standards that says as long as the preparer makes that judgment, since it's ultimately management's responsibility for the financial statements, as long as you make that judgment and document that judgment, you should be okay. That said, we're out of get out of jail free cards with GASB 84 here. We got to implement it this year. We were supposed to implement it last year but because of COVID, we got an extra year. So now is definitely the time. So GASB 84 not only impacts fiduciary component units such as pension and OPEB plans, it also impacts external investment pools. If you're a public college or university or a public hospital, you may have an endowment. It also impacts pension and OPEB arrangements that are not component units. Those are mainly single employer plans, private purpose trust funds such as cemetery trusts, and funds that may be best termed the Wild Wild West. Those old, wonderful, but crazy agency funds that we know and love, and unfortunately, they're going to go away. Governments have routinely included a bunch of activities within these agency funds, all of which may need to be re-examined. When we get to the implementation ideas, in our fleeting time left before the end of our fiscal years, I would really suggest that you look at your agency funds very carefully, as they may change the most. As a reminder, there are 4 paths within GASB 84 potentially resulting in a fiduciary activity. Remember, this is within GASB 84. We have not touched GASB 97 as of yet. The first path is whether there is an existing component unit relationship that is providing pensions or OPEB. And the most common of these is a PERS plan relationship to a state. We're not talking about a statewide PERS plan relationship to the hundreds or thousands of participants. It is a PERS plan relationship to a state. The second path is whether there is an existing component unit relationship that does not provide pensions or OPEB. Common relationships under this area include, again, foundations for public colleges and universities that are component units, or public institutions of healthcare that are component units. Notice I say they are component units, legally separate. Others include external investment pools of states, and in some cases, counties that have their own external investment pool. The third path is whether there are any post-employment benefit arrangements that are not component units. Now, this is an area that may be greatly impacted by GASB 97. So let's keep our ears tuned in here. If not impacted by GASB 97, the more common scenario is a single employer defined benefit plan, typically found at a city. If it is held in trust, it is likely included as a pension trust fund prior to GASB 84 already. If it is not held in trust, it is likely included as an agency fund prior to GASB 84. Now, the final path, all the other potentially fiduciary activities, including investment trust funds, typically investment pools, endowments, and other fiduciary funds that are not component units. For example, in the town where my house is, this includes a conservation trust that preserves a pond a few blocks from where my house is. that many millennia ago was under a glacier. And there's a conservation trust that is not a component unit, and that would fit probably under that bucket 4. And then there's endowments for our libraries, and there's also endowments for our public schools in my town, and any other clearing accounts for uncleared checks and maybe deposits in transit. And many governments use these clearing accounts, and they may have the biggest changes that are going on. All of these may or may not result in fiduciary activities under GASB 84, and now must be further analyzed when implementing GASB 97. So let's dig a little deeper and let's go down path 1 a little bit further. Now, we've already had a decision that there's a component unit relationship that could be a fiduciary component unit, but we got to go a little bit further. Many practitioners skip this, even though there is a component unit automatically if it's a fiduciary. So we need to go a little further because of GASB 84 and GASB 97. In general, but not always, if an irrevocable trust is in place for pensions and OPEB, there is legal separation due to the trust documentation. But that does not always mean there's a fiduciary component unit relationship, especially without a defined benefit plan. Notice I didn't say defined contribution, I said defined benefit. There is a financial burden if the primary government is legally obligated or otherwise assume the obligation to contribute to these plans. Now, what does it mean, assume the obligation? We're talking about a special funding situation where there is a provision that says, say, on behalf of the school districts in the state will kick in 35% of the required employer contributions or something similar to that. That is some form of a financial burden to contribute to those plans. But stay tuned a little later when I talk about these irrevocable trusts. But do we have a component unit relationship? Whenever somebody gives me a question as to what is a component unit, the first thing I do is I share my screen and I share this map that is on the screen. And I've kept this up back when it was handwritten back in the 1990s, and now I put it into a PowerPoint, and it has to be updated every few years. Now, and I've been around for nearly 30 years. And my first standard that I had to implement as a government person was GASB 14 back in the day. And we're talking 1990, a long time ago. It's still among the most misunderstood and now amended guidance GASB has issued. To have a component unit, there needs to be some form of legal separation and accountability. We're not talking a separate fund. There has to be a document that establishes a separate entity. Without that separate entity and without accountability, there's no possibility of a component unit. So let's say we do have that legal separation. Then there are 2 paths with the decision point if there is a voting majority. Now hold that thought on voting majority, as your answer may change due to GASB 97 in a few slides. So let's assume that yes, there's a voting majority. Then the next decision is there some form of financial benefit or burden or imposition of will. A common element of financial burden is if there's some form of contribution from an employer to a plan. Another one could be required transfer of budgetary resources or the payment of debt service. If not, then not a component unit. We'll come to that, back to that in a bit. Now, if there was not a voting majority, then is there some form of fiscal dependency and financial benefit or burden? We need both of them, fiscal dependency and financial benefit or burden. If no, then it's not a component unit. Now, if you go down the map here, or the decision tree, and you answer yes in a lot of places, we're at a component unit relationship. And then we got to figure out in the lower left-hand corner here, is it a fiduciary component unit or not? But there's a problem with GASB 84 and component units. GASB made a little bit of a boo-boo. As governments were implementing GASB 84, they said to the GASB, wait a second, I have a relationship with a potential fiduciary activity. No, I don't have to go down the path of a majority equity interest because the provisions of GASB 90 don't apply. And quite frankly, they were issued after GASB 84. But wait a minute, the potential fiduciary activity does not have a board. It is legally separate. I got a trust, but what do I do? And this is where the going gets tough and the tough get going. So, well, now we have GASB 97 and its excruciatingly long title to potentially rescue us from this problem. And a problem it is, as many relationships with potential fiduciary activities have this issue. Legally separate due to a trust and no separate board. It's just a relationship. So what does GASB 97 do for these relationships? First, a potential component unit relationship needs to be analyzed. If there is a potential component unit, if the primary government performs the duties that a governing board would perform, and we have no board, then the absence of the board is the same as appointing a voting majority. You know, and we've seen this time and again where the city council adjourns and then 5 minutes later, you know, they make some administrative decisions on behalf of this sort of entity that's out there. How does this work? Let's say we have a defined benefit plan held in trust at a city. The city council instructs the city treasurer to serve on behalf of a board. Now, that would be, in effect, serving as a board. But there are major exceptions within GASB 97. GASB 97 excludes this step if the potential component unit is either a defined is either a defined contribution pension or OPEB plan or an other employee benefit plan, including certain but not all Internal Revenue Code Section 457 plans. That word certain is vital. You need to remember that. But we're talking major exceptions here for defined contribution pension or OPEB plans or other employee benefit plans. And again, under Section 457, but that word certain is absolutely key. So GASB 97, GASB 97 is really important. Given this change in GASB 97, the only thing left for this potential component unit analysis, and again, we need this potential component unit, this legal separation, is the only relationships left include defined benefit pensions, defined benefit OPEB, external investment pools at states and many counties, and other non-pension or OPEB potential component units. But we must test the component unit relationship first. And if we don't have that component unit relationships, GASB 84's other provisions are still there. Second, there needs to be, again, a reminder, that potential component unit relationship already. Got to emphasize it twice. Finally, the financial burden decision is only applicable to defined benefit pension and OPEB plans that are administered through trusts. If you don't have a trust, it's unlikely you have a potential component unit, but you still may have a potential component unit for other fiduciary activities, so don't forget about those. Now let's go back a little bit to our handy dandy decision tree, our map, and see where GASB 97 makes those key changes. Again, we got that legal separation, and the best way to do so is using that irrevocable trust in the case of benefit plans. The majority equity interest provisions do not apply. Therefore, we needed to default to that majority voting majority decision. But remember, the voting majority decision only applies to DB plans or perhaps external investment pools. But what if we got a defined contribution plan relationship or deferred compensation plan relationship? Well, we skip over the voting majority decision. To be a component unit that is fiduciary in nature, there we would have to have some form of fiscal dependency, or it has to be misleading to exclude. Both of these elements would be rare in practice. That a deferred compensation or a defined contribution plan would be a fiscal dependency or misleading to exclude. So you're all over here on the right-hand side of your screen, probably not a component unit, unlikely to be a joint venture. So what do you got? Stay tuned, folks. We'll tell you in a minute. So let's go down the road and not forget to have what does it mean to have an irrevocable trust? And I'd like to remind people about it, as my colleague and dear friend GASB project manager Lisa Parker calls him, my fellow New Englander. You need to have IDP to be a trust, not ADP. You can say A for assets. I means irrevocable. D is for dedicated benefits. P is for protection from creditors. And more succinctly, the contributions must be irrevocable. You can't take the contributions out other than to pay for plan benefits or to pay plan expenses, administrative expenses in accordance with the plan document, or perhaps provide loans depending on the type of the plan. The assets must be dedicated to providing benefits. And this is not GASB's rule. This is the IRS. It's the IRS's exclusive benefit rule, and it's under Internal Revenue Code Section 401A2. That rule is key. It requires that a qualified plan be maintained for the exclusive benefit of employees or their beneficiaries, that under the trust agreement, it's impossible at any time prior to paying the liabilities for any part of the principal or income of trust to be diverted for any other purpose. The paying of administrative costs to manage the benefits also falls under this IRS provision. Now, we'll talk about divorce situations in about 10 seconds, but the asset must be legally protected from creditors, meaning in this divorce situation, bankruptcy, legal trouble for the government or the beneficiary, the assets can only be used to pay for benefits. In a divorce situation, a qualified domestic relations order from a judge is allowable, and it doesn't mess up the exclusive benefit rule or the protection from creditors. But without all three, you got no trust. So keep this handy if your city council or whoever is in charge with governance really wants to know. So to get away from this jargon, what does this all mean? Let's say we have one of these relationships. Then do we have a financial benefit or burden? The answer is probably yeah, if the plan is held in trust and then we report. As discussed in GASB 97 summary, the requirements will result in more consistent financial reporting of defined contribution plans, defined contribution OPEB plans, and other employee benefit plans, while mitigating the costs associated with reporting those plans. This beautiful paragraph that is within GASB 97 summary, and of course it's explained in grave detail within the standard, it will be a benefit to a lot of governments that are out there. It reduces your burden. So to sum up on fiduciary component units, if there is an irrevocable trust, there is legal separation between the primary government and a single employer DB or DC plan. That separation is there for non-employer contributors and the plan administrator. Equivalent arrangements depends on the language of the law, the regulation, or some ordinance that created the arrangement. For multiple employer plans, the component unit tests apply. If there's no component unit relationship, then we go back to the rest of GASB 84 and 97. Now, it could be, that you're completely confused. So let's head back and think about the rest of the story. But before we do that, It could be that many of these plans may not be reported by primary governments. Many of these defined contribution or deferred compensation plans may not be reported by the government. Unless the plan is administered in conjunction with a defined benefit plan, usually utilizing an Internal Revenue Code Section 115 trust, or when the government has control of assets in accordance with GASB 84. But GASB doesn't have any gap over Section 115 trusts. So if you happen to be part of one of those PERS plans out there, and if you are the accountant or the auditor of a PERS plan, the statewide plans that are out there that happens to have a Section 115 trust, there needs to be consistent reporting. And if you decide to report one of these deferred compensation or defined contribution plans, just realize GASB 84 is out there. So again, now that you're completely confused, let's go back to square zero where we started about 15 minutes ago. And let's go down the path. We already went down path 1 and 2, and now we're beyond those paths. Now we're going to go to path 3. Is there a pensions or OPEB relationship that is not a component unit? There are a lot of these, and that we'll talk about in a minute. But that's path 3. That we don't have a component unit relationship, but we got some post-employment benefit relationship there. Finally, path 4, are there any other potential fiduciary activities that under GASB GAP prior to GASB 84 and this may include things like external investment pools, private purpose trusts, or even agency funds. By program, we know that external investment pools may include things like local government investment pools at states and the various savings trusts. For private purpose trusts, don't forget prisoner commissary funds and potentially college savings plans. Prior to GASB 84, agency funds included lots of different activities, such as intergovernmental payments. I've had situations, potentially child support disbursement funds. When I was a preparer, that's where we put our child support fund until we moved it into a special revenue fund. Payroll clearing and withholding, contractor check clearing, and some other zero balance accounts. All of these may need to be analyzed, and I haven't even scratched the surface of student activity funds yet. That's path 4. So now that we're beyond fiduciary component units, there may be some of these pension or OPEB arrangements that are still out there. You may be a fiduciary if your government controls the assets and they are administered through a trust. In this case, there could be defined benefit or defined contribution plans, or the government controls the assets and the assets are held for entities other than those within the reporting entities. We're not talking about you're holding assets for an agency within your government. Or a component unit. We got to be completely separate from your reporting entity. So not even disclosed as a related organization. Related organization's a little dubious. Let's go way beyond the reporting entity. You're controlling the assets and you're holding those assets for these long-standing entities well beyond arm's length. And usually prior to GASB 84, you used agency funds in recording and presenting this information. Now, let's think about this in terms of an external investment pool. As I know, many of you may be with a county, and the county has an external investment pool for municipalities or even not-for-profit or for-profit entities within the county. So let's say you're the county treasurer, and the EIP meets the definition of a fiduciary component unit because, hey, we got legal separation. We don't care about majority equity interests, and we have a voting majority as the treasurer is ex officio, and the other trustees are treasury employees. The administrative budget is approved by the trustees, which all happen to be treasury employees. So we have imposition of will. Therefore, we have a component unit. But what about control? Well, the answer is no. The county treasurer does not need to go down this rabbit hole to consider whether the office controls the assets, as there's no accountability that's needed because there's imposition of will. Remember, it's either accountability or imposition of will. You don't have to go down this route. The reporting then would be as an investment trust fund. In determining whether there isn't a component unit relationship, is a fiduciary component unit, control of assets, control of the assets of the component unit by the primary government is not a factor to be considered per GASB 84. So because you got an imposition of will, you don't have to go down that rabbit hole. And again, this is specific to a county treasurer. Okay, yeah, let's see. Okay, just what are these plans that are held in an agency fund? I mentioned a few slides back. A common example is when a group of governments form a defined benefit plan. One government in the group holds the assets, but to allow for flexibility, an irrevocable trust is not in place. There's no component unit situation established. Now, due to the provisions of GASB 84 and control, the assets are a fiduciary activity of the other governments, and the controlling government is a custodian. The amounts that pertain to the controlling government would be part of the government's own governmental or proprietary fund statements. Only the amounts pertaining to the other governments are going to be held in these new things called custodial funds. That word control is key. But understanding the word control is difficult. Control is present if the government controls the assets of the activity. This occurs when the government holds the assets or can direct the use, exchange, or employment of those assets to the specified or intended beneficiaries. Now, appointing a bank or some other third-party administrator, it really doesn't matter because you're signing that contract. Restricting assets do not matter. Use is described as the ability to expend or consume an asset for the benefit of, say, individuals, organizations, other governments, but beyond your government's providing services to them. A key provision is something that many of us, including myself, over the last 4 years have glossed over, or sometimes I forget. And that's in footnote 5 in the basis for conclusions of what is GASB 84. It's in this paragraph B11. But first, footnote 5, when a government appoints a designee to act on its behalf, the designee is performing the government's fiduciary duties and not assuming them. Thus, appointing a designee to act on our behalf does not alter our ability to direct the use or exchange or employment of the assets. The board added footnote 5 to clarify that if a government appoints a designee to act on its behalf, the government still maintains the control of those assets. The board also concluded that by eliminating the term administer, it would clarify that the selection of investment options or the determination of benefits would not by themselves result in a determination that the government controls the assets. You got to go down and figure out the rest of GASB 84. That means that using a third-party administrator is perfectly fine, but the government still must review those provisions of control to determine whether a fiduciary activity is in place. You know, I think about it when dealing with my own investments. You know, my investment advisor, he has to tell me he's a fiduciary, and that's in accordance with federal provisions. He has to tell me he's a fiduciary. That means he is responsible. But in many aspects, investment houses are not fiduciaries. You know, if you open up Robinhood, for example, they'll say in plain English, not a fiduciary. That means you make your own decisions in Robinhood, and you can't sue them for making your own decisions. And that's what that little tiny print says. So that word fiduciary is real important. Okay, so what about, you know, fiduciary activities beyond plans? Remember, we're still at control. And if we have control, then the next step would be, are the assets from different from different revenues other than the government's own source revenue. Examples of own source revenues could be from taxation, fees, fines, or other inflows that the government is parking in a fund that may have been fiduciary prior to GASB 84 to be spent in a future year. This happened all the time when I was a preparer, that my state legislature would call me up and say, hey, we just passed a law, park this amount of money into a agency fund and we'll tell you later how to spend it. We'll call it a trust. Under GASB 84, not a trust. Are the assets from some other source other than taxes or grants? Well, there's one major exception in this. If the assets are purely pass-through grants for which there is no administrative involvement or direct financial involvement, then they might be fiduciary. But in practice, many grants have matching or level of effort or some form of accountability for disallowed costs. Even in the CARES Act or in ARPA, there's going to be accountability for disallowed costs. So it might be difficult to get to a fiduciary activity here. Then it is a fiduciary activity if just one of the following provisions are met. So first, you got to meet the prior slide. And then next, the assets are administered through some trust. And again, we talked about that in detail a while ago. The assets are for the benefit of individuals where there's no administrative or direct financial involvement. As I say here, many situations, student activity funds might have administrative or direct financial involvement. So you got to be a little careful here. Finally, the assets are for the benefit of organizations, and others outside the reporting entity. And here, I'm going to go back here. Yeah, here it is. The assets are for the benefit of organizations and others outside the reporting entity. And this one may be common as funds are raised for not-for-profits, or in the case of municipal aid passed through from another government without any form of direct administrative or direct financial involvement. So this is where the word control gets a little dicey. If a government's holding, assets for the benefit of other entities, such as other governments, if it's a group of investments like an external investment pool, well, fiduciary activity. But if it's a DC plan and the participants make their own investment decisions, unlikely, a fiduciary activity. And the same holds true all the way down the line here. Again, there could be situations where some of these could result in a fiduciary activity and others do not result in a fiduciary activity. The degree of choice is controversial. What is the level where the participant is in control? If the plan is an ERISA plan, if the participant has a choice of 3 investments, the participants are in control of the investments, not a fiduciary activity. But those provisions are not in GAAP. We could use the definition of choice versus control, but again, not in GAAP. We're left with professional judgment in some cases. Now, I mentioned the jargon, administrative involvement and direct financial involvement. Those provisions have been in GAAP since GASB 24, and they've been replicated in GASB 84. By my math, 60 standards ago. And they haven't changed much. They are going to change a little bit in terms of text coming up in a few years because we don't use EBT cards anymore. We use SNAP. And by the way, not much in GASB 24 has changed. We don't use food stamps anymore. Administrative involvement is mainly monitoring for compliance, determining eligibility. We're talking more than a rubber stamp, the ability to say no. Direct financial involvement is providing matching or level of effort or being held accountable for disallowed costs. Again, for those of you who are dealing with CARES Act or ARPA, you're about to deal with, you're going to be dealing with being held accountable for disallowed costs. Just stay tuned. So to sum up on control, it really is up to the government making the judgment. Every government is going to be different. So don't look at your neighboring government and think that If they made the judgment they have control, then your government must have control. Again, every situation is different. We're going to use similar fact patterns for different governments. And we're going to see that it could result in very squishy situations. And especially when you get into things like student activity funds, student club funds, and other activities. Some may result in fiduciary activities, others may not. So let's dig a little deeper. Here we have a county investment function in a defined contribution plan. Notice it's a DC plan. Different paths will have different results with each layer. Notice how having a trust is a determinant, and if something is a custodial fund or not. But the most important aspect may be this word choice beyond whether there is a trust in place. If a participant can choose investments in a DC arrangement, absent any other facts, it might not be a fiduciary activity. But in the immortal words of Steve Jobs, God bless him, there's more. This one is pretty much out here on the street. And I'm hearing some noise in the background. Brian, is your mic on? There you go. This one's pretty much out on the street. It's in GASB's Implementation Guide Update 2021-1, question 4.3. It was approved last week at the GASB. I think it was approved Thursday morning. Yeah, Thursday morning last week. So it's in production right now. There are some minor modifications to this question in terms of moving commas and stuff like that, but the gist is there. If participants can direct the individual assets in an account in an employee benefit plan, even if the government can change the investments, is the government in control? The answer is, come on, here, wait a second. No, the government is not in control. This impact is huge. Self-directed plans and those plans that are like it are unlikely going to be fiduciary activities. There'll be no change in your government's relationship with a DB plan like a PERS or a STRS. But for all other employee benefits, including deferred compensation, unlikely a fiduciary activity. That was the issue that I brought up in the polling question out there. Now, I've gotten questions from you asking if I can still present a 457 plan that is purely deferred comp. It's purely employee money, not employer money. Well, if it's in the same report as the government, you could have a departure from GAAP. My advice, it's unclear now until I see a state and local audit guide provision on it. And my advice, maybe do a separate report on it if you really want to have a report on it. Now, that means separate audit, separate materiality, and so on. But if the government seeks accountability, that's a small price to pay. So let's take a look a little bit deeper. Here's a real situation to show what big of a change this could be. Let's say you're a county. You got a separate DC plan using an irrevocable trust that has all the required elements. The DC plan is in addition to the county's employees being eligible for the statewide PERS plan. Kind of common situation. Now we have no board in the DC plan, but we do have a TPA. We hired the local bank to say, hey, administer this DC plan out there. The county contributes based on somebody's age and length of service. However, the employee can direct the investments through the bank, even though the county established the investments that may be bought or sold. Now, as a result, let's go down the decision tree here. We got a legally separate plan due to the irrevocable trust. We don't have to go down the road of a voting majority as the county commissioners serve on the board. Is there a financial benefit or burden? Yeah, but we've met GASB 97's exceptions. Is there fiscal dependency? Yeah, as the as it's being administered by the county, and the county also approves the contribution rates. But we don't have a component unit relationship, and since the employees are in control, no reporting. other than the outflows from where the payroll is generated. So this is a big deal, ladies and gentlemen out there, and it's a big change. So enough about control. Let's go down and talk a little bit about own source revenues. So again, different facts provide different answers. For example, let's say a city collects cash for a cemetery association that's not a component unit, but it has a separate board. It's not own source revenue, fiduciary activity. But a license fee, is charged to businesses and shared with the state, then the government's levying its own fee and passing it on. Not a fiduciary activity. The same goes for prepaid tuition plans, which are becoming less and less prevalent as being open. Yes, they're still out there, but they're not open to new investors. Prepaid 529 plans have a product or service provided by a state for a fee and therefore own source revenues. But again, everybody's facts and circumstances are different. So don't just say these are gospel and apply to you. You need to analyze your own facts and circumstances. So many of you have asked about student activity funds and similar activities such as booster clubs. The problem is some of those decisions for GAAP purposes may be different than those for a state Department of Education compliance purpose. So you really need to be careful. I got to tell you, ever since GASB 84 came out, one of the state society of CPAs I belong to is in Massachusetts. And since GASB 84 was in its exposure draft stage, so we're talking beyond 4 years ago, that State Department of Education has been trying to formulate rules and policies and procedures for student activity funds. And we're talking at least 5 years and trying to come up with succinct policies and procedures. So this is a fairly big deal for a lot of us out there. So there's some key decision points on student activity funds. First is whether there is control by the educational entity, whether is some form of direct financial involvement, such as matching funds, whether some form of administrative involvement. Now, in some cases, the funds are for separate parties, such as fundraising for not-for-profits and so on. Those are easy peasy. That's low-hanging fruit. It's the other three that get a little dicey and need a little work. There are lots of questions on student activity funds in the implementation guide to GASB 84 and in the implementation guides that followed in 2020. And now we got more in 2021. And so look to the GASB's implementation guide for some really succinct stuff. But the vast majority of questions that the folks at GASB have been asking, have been answering on behalf of you have been related to student activity funds. So let's go through a few. Here we have a chess club. It's not legally separate. The club raises funds to pay for activities. The proceeds are held in a school account. The club is not legally separate. Therefore, GASB 84 decisions will need to be made. If there's some form of accountability, say decision-making by the teacher or administrator, I'm a little closer to a governmental activity than a fiduciary activity. And here's why. If the school district matches funds, that's classic direct financial involvement. To me, this could be a governmental fund. Now, here is the other extreme. Here we got students raising funds for disaster relief. Funds are held in a separate bank account and a check is written to the not-for-profit. This is just a straight ahead pass through and likely in one of these brand new custodial funds. Now here we got an alumni booster club and it's made up of parents and supporters. It's not really a component unit if the funds are not held by the school. No reporting, not a fiduciary activity. And then now we got a ski club. And for those who are still skiing, I have a cousin who's out in Colorado. He skied yesterday. So for those of you who are still skiing, hey, that's cool. This one's interesting and kind of one to circle. In this case, we have either teachers or administrators who approve the spending. The district holds the resources, and therefore we do have administrative involvement because we got the teacher or administrator approving the spending. Beware, though, this could be in a governmental fund. Now, think of the permutations on this one. If we move it into a governmental fund, and if your government budget's all governmental funds, do student activity funds have to be budgeted? That's one for you to chew on for a little bit. Could be for sure. But there are other activities that need to be analyzed beyond student activity funds. For those with printed copies or can write on the screen, circle the first one, payroll deductions. That's a biggie, as my grandson says, biggie, not a fiduciary. Fees charged to manage fiduciary activities, not a fiduciary. Pass-through taxes, fiduciary. These and many more are in the implementation guide. Before we go on, I did get a couple of questions. Let's see, yeah, we answered that. Okay, for a DB OPEB plan for a single employer, I don't need to review GASB 97, right? Well, you should review GASB 97 anyway, but as long as you have a DB plan, you got to review if you got some form of legal separation. But even if you don't have legal separation, you still got to go back to GASB 84. So that's a great question. In all likelihood, with a DB plan, if it's held in trust, you're probably talking a pension or other employee benefit trust fund. If it's not held in trust, probably a custodial fund. And so that's a great question that came in. So let's go back down the road here. Wait a second. Let's go back. Okay. Come on, screen. There we go. Okay. I'd like to spend some time talking to you about these things I mentioned a few times, custodial funds. As the reporting of custodial funds is brand new due to GASB 84, I think all of us need to take a screenshot of this, print it out, tape it onto our monitors. I got to tell you, I think it's at least once a week. Now, can I convert agency funds directly over to custodial funds? No, they do not equal. They don't. Get it out of your mind's eye. They are different. Don't make the mistake of moving all your agency funds into custodial funds. And in custodial funds, assets will not equal liabilities. You'll have a real P&L here. Now, there are some exceptions to reporting for business type activities where funds are held for 3 months or less. Now, yeah, those will just be payables from the operating fund. External portions of it, investment pools not held in trust, also custodial. So those are some exceptions. But by and large, there will be major changes. Now, for the auditors in the Zoom call, there is a technical thing out there that was put out by the AICPA, and you need to be aware of it. Now, the TQAs also describe a provision that the reporting of fiduciary activities applies to special purpose governments engaged in business type activities. In some cases, governments will be reporting fiduciary activities for the first time. Now, this assistance or this explanation from the AICPA describes how an auditor would assess the appropriateness of such a government's omission of its only fiduciary fund in the financial statements when the government considers the omission immaterial. Now, if immaterial, no further work, no procedures are needed, and you don't need to reference it in the auditor's report. But you got to document that decision, auditors out there. So remember this TQA as you're auditing GASB 84 for business type activities for the first time. So here's some problems that we've run into in transitioning the old agency funds. First, what's the beginning balance as GASB 84 is implemented on the period that began July 1st, 2020, almost a year ago for a June 30 government. Now, obviously, you may be different fiscal years, but it's as of the beginning of the year. And by the way, if you present comparative financial statements, including notes to the basic financial statements and RSI for 2 years, except for the MD&A where you have 3 years of analysis, you really got to go back to July 1, 2019. Got to go back 2 years. And by the way, if a material amount moves to a governmental fund as a payable, does an opinion unit and major fund change? The answer may be yeah. The second problem is, how do you adjudicate what activities are in agency funds that are purely custodial and they need to remain fiduciary activities? When I was a preparer, we had agency funds with, the alphabet soup in them. It was a bouillabaisse. And we had, and whoever's preparing them nowadays, they better be separating out those individual fiduciary activities. It's hard. And then finally, what about your reporting system? Can they handle the changes? Some of us have designed reporting systems that are pretty hard coded. A change like this could be pretty major. And then, of course, think about your budget. All three of these need to be considered when transitioning the old agency funds. Don't make that big mistake and just blanket movement of the balances in the old fund. That's going to be down a rabbit hole you do not want to go down. So the biggest movement for many governments is the removal of payroll withholding from an agency fund. This is a big deal. No payroll withholding will no longer be a fiduciary activity. And the amounts must be restated as of the beginning of the period. But what number? If the funds are going back to a governmental fund, remember, you got a different measurement focus and basis of accounting. Now, granted, agency funds were supposed to be full accrual and governmental funds are modified accrual. Could some assets and liabilities be removed due to the change in the basis of accounting? Well, yeah. Do not underestimate how complex this is going to be, especially if your government has been using a payroll withholding account forever. Trying to reconcile that account will be difficult. When I became a deputy state controller many, many years ago, I asked my team to try to reconcile the payroll withholding account. For a state, it took them 3 years. And they found that they were $24 million off. And then, of course, we had an IRS audit because of it. So don't underestimate how complex this might be in reconciling the payroll account, and it could result in a major fine. Here's where I would go look, for custodial funds after you implement GASB 80 or as you implement GASB 84. Maybe a cemetery not-for-profit fund administered by a city but not held in trust. Investments not held in trust. Sales and other taxes and fees such as licensing fees passed through to other governments that are not subject to appropriation. Now, if municipal governments have their own court system, say one state has made a judgment that per its operations, the court fees are remitted to the state, that would be a custodial fund. That seems pretty reasonable. But if the activity is just fines and fees and the municipal governments retain them for public safety budgets, not a custodial fund. So think about it as you're doing all these moves. Now, one interesting aspect of GASB 84 is reporting fiduciary activities doesn't change all that much. And I know this is small, but it's in your printed copy. The statement of net position looks pretty much just like GASB 84. Now, I've copied a real government, but remember, do not copy your neighbor. Your government may be totally different. Now, I redacted things to protect the innocents. This is from a state, and I think the state knows who they are if they're online, and I thank them for it. Notice that they run lottery prizes through a custodial fund, and this is really great reporting. Now, again, from the same state, and again, I thank them for this. They do have multiple defined benefit plan fiduciary component units, although child support is run through a custodial fund. Notice that the additions and deductions can be aggregated by source if they're meaningful. So pretty easy peasy, not too much to change. You will notice that there is a line here that says investment expense, and that's okay. That's there. I would suggest changing that word expense to cost because there was a change in GASB 84 paragraph 23B. Now, a couple other things, again, the biggest impact is that change statement that I just showed you. Investment income is presented gross of these investment costs. Custodial funds can aggregate inflows and outflows of resources if the categories are meaningful. A business type activity that chooses to report resources in its own statement of net position could report additions and deductions separately if they're significant as cash inflows and outflows in the operating activities category of the statement of cash flows. Liabilities in the statement of fiduciary net position may have some minor adjustment, but not much. The updated guidance is based on the presentment for payment. Now, I mentioned this thing, investment costs. What are investment costs in GAAP? This one may be slightly different than what you're reporting now. The key is separability from other administrative costs and investment earnings. You may have heard that the GASB has been performing research into investment costs, but as of right now, there's no project in it that's been added to the current agenda, and it may never occur. Whatever the cost policy is, please document it. But by the way, don't these guys look like they're having fun? Yeah, I kind of wish they were, that they weren't having so much fun. Clearly they are looking like they're having fun. But wait, we still have some other stuff to go on GASB 97. Remember a while back, I said that word certain. And that word certain is vital when talking about GASB 97. And why? Well, Internal Revenue Code Section 457 plans they've had some issues in reporting since the issuance of GASB Statement number 32 in the late 1990s. If you read the Internal Revenue Code, Section 457B describes these plans as deferred compensation plans. Most plans we run into in practice are just the employee withholding. But some governments have thought they were in control, while others thought that since the funds were employee funds, they're not in control. Those governments that felt they were not in control thought they weren't even pension plans. And I can remember when Statement 32 came out before GASB 34, I went up to my state treasurer and who had an office there for a very well-known global bank who was handling the 457 plan. And I said, I need the financial statements for the 457 plan. Got to give them to me. Very, very big global bank. And the very, very big global bank said, no, it's a deferred compensation plan. It's just your money as an employee. And you don't need it as a state controller. And I got all miffed and I got all mad. But finally, I put my tail between my legs and I said, okay, I'm just not going to report it. And that was back in the 1990s. Well, there's been chaos ever since. Hopefully, GASB 97 will end that chaos. First, a 457 plan of any type, and there are multiple types, they need to meet the definition of a pension plan. So you may ask, what's the definition of a pension plan? Well, it's right here on the screen, and it's straight out of GASB 67. An arrangement through which pensions are determined, assets are dedicated for pensions are accumulated and managed, and benefits are paid as they become due. If a 457 plan does not meet this definition, it's an other employee benefit plans, and then governments go back to GASB 84. In other words, you might not be in control. Now, there are a small handful of 457 plans out there that are defined benefit. These are rare. These are rarer than the rarest steak you've ever had. These are real bloody. If so, these rare plans would be reported just like a pension plan in GASB 68. In most cases, they would be defined contribution plans, but in extremely rare cases, they may be defined benefit. If there is a 457 plan that is a pure defined benefit plan, please call me. I want to see it. I really do. and we'll have some work to do together. And we'll talk about some of that work in a minute. Don't get caught up in the Internal Revenue Code and whether or not the code section defines a fiduciary or not. And I've been mentioning Internal Revenue Code sections all through this presentation because it's kind of a handoff. You must go through GASB 84 and 97 and document your decisions made, whether a 403B plan or a 401k plan, it really doesn't matter. Go through GASB 84, document your decision. All right, how do you implement this beast? How do you get through GASB 84 and GASB 97 while retaining your sanity? GASB 84, implement it right now. You've had an extra year and that year is gone. Report it now. GASB 97 for component unit adjustments, given there's relief in reporting, implement it now. For 457 plans, those have a year or more to go, but remember, most of those may no longer be reported as there may not be control. Now, there were 2 dangling implementation guide questions that were suspended earlier this year with the issuance of Implementation Guide 2020-1. Those are now reinstated. Now, for those of you who happen to be a 457 plan, one of those rare, bloody steak DB plans, well, you need to implement GASB 97 using the provisions of what I spent my morning talking to the GASB about, GASB 68. The defined benefit statements. And given that we're pretty close to 10 years on GASB 68, we're getting closer and closer, you got to go back to when you implemented GASB 68. That includes an actuarial valuation, deferred outflow of resources for contributions made after the measurement date. And as we remember for our work in GASB 68, so much more. So if you happen to have one of these, I want to talk to you about it. So what if your government implemented GASB 84 already? Check and see if a restatement is required, usually relating to some decision made on a DC or other employee benefit plan. Should you implement the rest of GASB 97 early? Sure, as it'll make your life a little bit easier in some cases, but be careful. GASB statements are all or nothing unless allowed by the GASB. In this case, you got to implement the whole statement, not just pieces of it. As you can probably tell, this is not going to be an easy implementation. Gather the information, including the laws, regulations, trust agreements that support your decisions. Compare those proposed decisions to 84 and 97, and then document your decision. Again, don't look at your neighbor. Different facts and circumstances could result in different decisions. Now, here's the freely available advice from the GASB in addition to what is on our website. Remember, 4 statements are involved, and now 2 already implementation guides, and the 3rd one that is in the process of publication. So there's 2 Q&As in that 2021-1, one of which was in this presentation. So with that, so let's just see. Okay, let's see if we have, okay. I got some questions here. Okay, this is a good one. For a payroll withholding account, can we move the cash and liabilities from the payroll withholding fund over to the general fund? And follow up, meaning have the cash and liability now in the general fund that had previously been in an agency fund? I would definitely say in practice that will be what happens, where you take your beginning cash and payroll withholding, assuming that you pay within a reasonable amount of time at the end of your period. Let's say you got a 60-day accrual, in your general fund. Yeah, I'd probably move it over there, and it probably won't result in any form of adjustment. Now, getting there, remember, you got to do your note disclosure of that adjustment, that beginning balance adjustment, and so on. If you have some longer term accruals, or maybe that amount that you're moving over has not been reconciled, will you have an audit issue? Perhaps. But somehow, some way, I should be able to tie the cash and I should be able to tie the payable to some form of reconciliation. And remember, don't create cash, don't double count cash. So you got to be real careful on that one. Okay. So here's a good one that just came in under the wire. How does a district deal with a county office that continues to post things in an agency fund, even though the county is aware of changes in GASB? This is going to be so common. GASB 84 does not require you to change your budget, does not require you to change your systems. No, you're going to see this over and over again. And so guess what? For the folks who asked the question, the burden's going to be on you to make that adjustment, unfortunately, unless you can convince, the county to change their system. It's going to cost far more to change your system than it will to change your financial reporting. And so unfortunately, that's going to be a real challenge. And so I'm with you on that. If I was a preparer and had an agency fund, or maybe had a situation where I used to have where I had 61 component units, I'd be really, really hard pressed right now. And because there's no way they're going to change their systems. All right, let's see if there's any others in our fleeting 90 seconds here. I see none. So let's give you a heads up. Next month, we were supposed to do a year-end prep for GASB. Guess what? We have converted that to the first of 3 GASB 87 workshops. This one focusing on lessees. And this will be real hands-on, get your fingers dirty as much as we can do on Zoom, GASB 87. So join us next month. It is coming up later in June. And also, to give you an announcement, we are preparing town halls on the American Rescue Plan. So stay tuned for that as well. Probably coming later on in June. There will be 2 additional workshops on GASB 87, both coming in July, one for lessors and one for special cases. With that, okay. Oh, I got one really, at the end. How would you treat a 457B plan that houses employee contributions and a 401A plan that houses the employer matching contributions? 401A plan, you got to go down through GASB 84, see if you're in control. 457B, just employee contributions. If the employee has the ability to make their own decisions, even from a slate of investments made by the employer, chances are for 457B, not reported, just outflows. If you want to do note disclosure or supplementary information, up to you. My advice, supplementary information if you really want to have some accountability. But at the employer side, 401A, you got to go down GASB 84 and GASB 97 to see if you're in control. With that, we will see you next month for our first of our 3 workshops on GASB 87. Everybody stay safe out there and have a great afternoon.
One thing before everyone signs off to you, Eric, just a reminder that if you did participate in the polling questions today for CP credit, you should receive your certificate by email within the next 10 to 14 business days. So thanks again, Eric, and thanks everyone who called in today, and have a great afternoon.